I think there will be many more all-time highs in the months to come. So we're still far away from this 500k average that the stock-to-flow model predicts, but we also have almost 3 years to go in this cycle. So there's a lot of time to reach those levels. So there's a lot of selling of old Bitcoin holders that put this money back in Bitcoin through an ETF or MicroStrategy. So it's a rotation actually, and not much new money. Once that rotation is done, however, and the new money flows in, of course, that's when the price should reflect the scarcity and supply shortage that we have right now in the market.
Bitcoin's recent market activity might look intense on the surface, but it's more of a strategic reshuffle than a true influx of new cash. What seems like volatility is mainly driven by experienced holders selling their coins and then re-entering through channels like ETFs or firms such as MicroStrategy. This isn't a rush of fresh money coming in, but rather a calculated reallocation of existing asset. Adding depth to this view are market experts like Tom Lee, known for his keen foresight, and PlanB, famous for his data-driven analysis. Both emphasize that much of the recent price action reflects long-term investors shifting their positions rather than new capital flooding the space. Despite the hype surrounding Bitcoin ETFs, which have become some of the most in-demand financial products ever, the market has yet to experience the explosive growth many expected. Bitcoin continues to trade above important realized price levels, holding steady near $17,000, but without significant new institutional inflows, the price isn't surging. Instead, existing holders with large unrealized gains are circulating funds internally, keeping the market active but contained. Meanwhile, key infrastructure players like Coinbase and Circle report strong growth and impressive stock performance, signaling underlying strength in the ecosystem. However, Bitcoin's trading remains highly volatile, with the broader market closely watching for signs of fresh capital that could spark the next price rally. Given Bitcoin's ongoing scarcity and supply constraints, the potential for accelerated price gains is real, once new drivers enter the scene and push momentum forward. This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to portfolio, tap your Solana asset, then click close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
I think there will be many more all-time highs in the months to come. So we're still far away from this 500k average that the stock-to-flow model predicts, but we also have almost 3 years to go in this cycle. So there's a lot of time to reach those levels. So orange means months until the next halving. So orange would be, 33, I think 32, something like that. Months until the next halving. Now note that 40% of the people thinks that Bitcoin will not reach 200,000, that's this line, before the end of 2026, that's this line. So looking at this chart, I think it will go to the stock flow level and at least go to this 200k level. Yeah, I think that's behind this relatively flat bull market. So there's a lot of selling of old Bitcoin holders that put this money back in Bitcoin through an ETF or MicroStrategy. So it's a rotation actually, and not much new money. Once that rotation is done, however, and the new money flows in, of course, that's when the price should reflect the scarcity and supply shortage that we have right now in the market. So what we see is that all the realized prices are increasing, which is good, and Bitcoin is at 107,000 above all those realized prices. And that's a typical signature of a bull market. You can see it in every bull market all the realized prices are increasing, and the red dots, the Bitcoin price, is above them all. You see it here too in 2017, and you see it in 2013. So again, classic bull market behavior. Now, combining all the charts from low to high, we see the moving average, 200-week moving average at 50,000. We see the 2-year realized price at 84,000, and we see Bitcoin price at 107,000. Now, the color is, of course, in this chart, the RSI, 14 months RSI. I got some questions about that. It's 14 months. Green, yellowish, it's 70, right? We talked about it. It's still not at bull market levels. I expect that to come very soon.
Bitcoin remains well below the $500,000 average projected by PlanB's stock-to-flow model, with nearly 3 years left in the current cycle. The chart indicates about 32 to 33 months until the next halving event. PlanB also acknowledged that some market observers are skeptical Bitcoin will reach $200,000 before the end of 2026. However, he points out that all realized price metrics are rising, a hallmark typically seen in bull markets. Currently, Bitcoin trades around $17,000, which is above all realized price indicators, mirroring patterns from previous bullish phases. Key supporting data includes the 200-day moving average near $50,000, the 2-year realized price at $84,000, and the 14-month RSI at 70, all signaling upward momentum, though not yet at full bull market strength. Meanwhile, market strategist Tom Lee explained to CNBC that Bitcoin's recent price stagnation is due to two main factors. First, a significant portion of ETF inflows comes from existing holders reallocating assets, rather than fresh capital entering, which limits net buying pressure. Second, early adopters with large unrealized gains are beginning to sell near the $100,000 mark, creating resistance that slows upward price movement.
Take us through why, even with more allocative instruments, especially in exchange-traded products, that we are not seeing as much of a price improvement in Bitcoin when there's an actual construct for actually putting money into it?
Yeah, that's a great question. I mean, we know Bitcoin ETFs are the most successful product launch like in history. And then someone says, well, if you're going to collect that much money, Bitcoin goes to the moon. But it turns out Bitcoin's risen, but it's kind of churned. I think what happened is a couple things. One is a lot of these ETFs may have been receiving in-kind exchange. So people have their crypto keys, give it to the ETF provider, and then they just stepped up their basis. So that's not going to push up the price of Bitcoin. It adds to their AUM.
A wash.
Yes, it's a wash. And the second is that the ones who aren't involved in ETFs, but maybe they have $10 Bitcoin. We have clients that have bought Bitcoin at $100, and now it's $100,000. They're not looking to, they don't care if Bitcoin goes to a million. They are probably sellers at around 100,000. So we're churning the base now because 95% of the institutional world doesn't own Bitcoin, but a very significant portion of Bitcoin holders are sitting on huge gains. So I think this is the churn that's happening in Bitcoin now. But of course, the companies that serve Bitcoin, like Coinbase or Circle, have seen huge growth, and they've been the best IPOs and the best stocks. So it's almost like maybe you won't make money trading Bitcoin, but look at the infrastructure providers. They've been great stocks.
I think that it is appropriate that we are making new highs because the fundamental and the visibility is better now than it was in February at the old highs. And I think there's three levers that are going to get pulled. One we know is that the Fed didn't unleash liquidity at the April lows. So we have a Fed that's been on hold and tight. But if the information and the data comes in dovish, that's 12 to 24 months of Fed liquidity and dovishness. That hasn't happened yet. The second is that I think that there is a false argument. People are saying the multiples are stretched. The PE should be expanding because we've now had 5 stress tests that companies survived. They survived COVID, they survived the bullwhip effect, they survived the inflation surge, they survived the Fed fastest hikes, and now they survived Armageddon. If you don't have 5 more episodes, multiples will be higher 2 years from now. And the third is that I agree with anybody who says that, look, we've kind of reshaped some of the economic flows around tariffs, but that's an upside story because if it plays out better, that's an earnings surprise. So you have 3 levers that tell us that 6,200 is the market beginning to recognize we're in a better position, while $7 trillion cash is on the sidelines. And I can tell you, our clients, institutional clients, remain very skeptical. This is the most hated V-shaped rally. There's a couple things to keep in mind. One, In fact, money market balances have declined. They only started to rise really in 2022.
Right, they had a stutter step and then they went up.
If you look at margin debt, NYSE margin debt, the dollar amount absolute is still below where it was in October 2021. So you have like 4 years, it's 4 years and you're still not even higher in margin debt. And third, it really doesn't take, you don't need 60 trillion to come into the stock market to have it rise 10%. You probably need 200 billion. And I think there's a lot of high net worth money. I know there's a lot of our institutional long short macro that is shorting this rally. The long only managers are defensively positioned. They don't believe in a cyclical long. But look, if rates come down and the Fed starts easing, it's going to force people into a cyclical tilt. Today would have been a day where if it was weak, then the Fed has to change its calculus. But the job market's good. So now the waiting game is, how much will inflation surge over the summer? Inflation expectations are actually coming down. So now all that we're waiting for is let it get through this CPI hump. I do think it means that once you get into September, we should really think about cuts coming. And that's what I would focus on more as an investor, that, well, that's a cutting cycle. The Fed won't just do one cut. They're going to continue cutting. ECB and the U.S., 200 basis point different in monetary policy rates. But if you take CPI year over year ex housing, which is how Europe calculates it, we're both at 1.9% today.
So the stock market is not as if, it hasn't really been leaning in the direction of we're headed for weakness in the economy.
Yes.
So what growth do you feel as if is now kind of baked into the market?
That's a great question, because you're right. I'd rather see industrials flat on their backs because the ISM's been below 50 for now 29 months. It's the longest stretch of being below 50 in its history of the survey. So I think there is pent-up spending, but the stocks have moved.
Yeah.
Consumer confidence is flat on its back. Now in 2009, it was flat on its back, and we did a study back at JP Morgan that showed the best time to own consumer cyclicals is when consumer confidence is negative. So I'd say there's less upside for both industrials and consumer cyclicals, probably more for financials and small caps. But there is this relief from businesses as we move back above 50. And I think getting this bill passed and getting the tariff behind us will push the ISM back up, and it should lead to earnings growth. I won't blame any investor who says, fool me once, fool me twice, fool me 3 times, like I'm not P.T. Barnum or whatever. But I do think it really depends on the Fed being committed to continuing its easing cycle. That's the setup we had before. And I don't blame investors for being really reluctant. But the good news is since the April lows, small caps have been outperforming and have the banks. That's kind of the participation you want to see.
During the recent stock market pullback, Bitcoin dropped only a fraction compared to equities, shifting its narrative from pure speculation to a tool for risk management. Unlike stocks, Bitcoin's price didn't plunge in lockstep with economic fears, highlighting its role as a portfolio stabilizer. This independence makes it strategically valuable, especially as we face rising interest rates, inflation, and geopolitical uncertainty, times when preserving value matters more than chasing gains. When influential leaders publicly recognize Bitcoin's resilience, it signals to institutional investors that Bitcoin belongs in serious financial strategies, not just theory. Billionaire investor Max Keiser recently made one of the boldest Bitcoin predictions yet, forecasting $850,000 per coin within this cycle, a figure that implies a potential 1,000% return over the next 5 years as Bitcoin reaches parity with gold. Keiser, who has been an early Bitcoin advocate through all its ups and downs, points to macroeconomic trends like global money printing, mounting debt, and weakening currencies as drivers that make Bitcoin more than just a hedge, it's a solution. Institutional adoption is no longer a niche story. It's becoming the standard, with companies and sovereign wealth funds increasingly embracing Bitcoin as a reserve asset. This shift in mindset and capital flow marks a major turning point for Bitcoin, moving it from a fringe asset to a core financial holding. Keiser's prediction isn't just about price, it's about changing how we view growth in volatile markets. His clear, confident call for $850,000 this cycle challenges both longtime holders and newcomers to recognize that Bitcoin isn't waiting, and neither should they. So, what do you think will trigger the next big wave of investment into Bitcoin? Let us know in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.